this week's market update, oil jumps again as Trump targets Iran. Earnings season gathers pace, the S&P 500 hits a new all-time high, and Japan celebrates a new imperial era. Commodities are in focus this week as both oil and pork prices soar for different reasons. First, oil. The cost of Brent crude rose to a 5-month high this week after Washington announced the end of sanction waivers, which had allowed a handful of countries to continue importing Iranian oil despite last year's clampdown by the US on exports from the Middle Eastern country. When the Trump administration blocked most countries from trading oil with Iran last year, it left the door open to India, China, Japan, South Korea and Turkey. Now it's decided to tighten the squeeze on Iran, effectively slamming the door on all Iranian oil exports. Mike Pompeo, the US Secretary of State, said the aim was to reduce Iran's crude exports to zero, warning that how long that target remained in place would depend on Iran's behaviour. The move follows the US branding Iran's Revolutionary Guard as a foreign terrorist organisation last week, the first time America has attached that label to part of another country's government. The oil price, which has already risen by around 40% since the end of last year, rose to a new recent peak of $74.64. That's its highest level since November. When you consider that Iran exports around 1.3 million barrels of oil a day, the upward move is actually relatively small and suggests that traders are relaxed about the ability of other producers, like Saudi Arabia, to step in and fill the shortfall. Goldman Sachs is sticking with its forecast trading range of $70 to $75 a barrel for the second quarter of 2019. Despite that, the shares of the oil majors rose on the higher oil price, as did the currencies of oil exporting countries like Norway and Canada. Now, whether the US is able to enforce its tighter sanctions remains to be seen. China relies on Iran for about half of its oil and has criticised the move. India is also a big importer of Iranian oil. The issue of waivers has complicated the supply-demand balance of the oil market since last year. Ahead of the introduction of sanctions, the US persuaded Saudi Arabia and other OPEC members to pump more oil to cover the loss of Iranian supplies. That pushed the price lower. But the unexpected waivers then resulted in a glut of oil on the world market, which pushed prices even lower and further down than Saudi Arabia is comfortable with. It has subsequently cut back on output. Donald Trump will be watching the oil price closely. Ahead of next year's presidential election, he's keen to avoid a squeeze on the US economy from sharply higher energy and fuel costs. The price of petrol is already at its highest level since last October, and another 10 cents per gallon would see it at its highest level for 5 years. Meanwhile, at the company level, higher oil is having an obvious effect. BP and Shell both rose strongly yesterday, while EasyJet and British Airways parent IAG fell back. Ryanair had its worst day since December, down nearly 5%. On to pork, where the issue is also a supply shortfall, this time thanks to the spread of disease to China's pig population, the world's biggest. The number of pigs in China is expected to shrink by almost a third, losing 130 million animals, as so-called African swine fever sweeps the country. The virus has no cure and it's fatal to pigs. Starting in Africa, it's spread through Russia to China over the past 10 years. The outbreak could have an impact on meat prices for years to come. Despite claims from Beijing that it had the situation under control, it's now admitted the scale of the problem and has forecast price rises of 70% year on year in the second half of 2019. China is the world's biggest consumer of pork, with 55 million tonnes of pork products consumed a year. The country is estimated to have half the world's pigs, and it's in the process of losing 30% of them. The shortage of pork may be even more noticeable this year and have a bigger inflationary impact because Chinese retail, including restaurant sales, are currently enjoying the benefits of the latest round of stimulus from Beijing, which, unlike previous rounds in 2008 and 2015, is aimed specifically at the consumer. In the past, China has attempted to offset a slowing global economy by throwing money at infrastructure projects and big state-owned enterprises. This time, however, it's focused on measures like cuts in VAT to help smaller companies and individuals. Consumption now accounts for half of GDP as the Chinese economy matures into a more developed model that's less reliant on exports and more on domestic spending. That's good news for the Chinese stock market, which has seen the Consumer Goods and Services Index rise by 23% so far this year. It's probably less good for previous beneficiaries of Chinese stimulus, such as Australian miners, for whom more consumer spending is less helpful than growth in spending on roads and bridges. Staying in Asia, the coming week is a big one for Japan. It's not every year that a new imperial era begins, but the abdication of Emperor Akihito in favour of his son, Crown Prince Naruhito, ushers in the Reiwa era on May the 1st. Since the birth of modern Japan in the 1860s with the Meiji Restoration, there have in fact been only 4 eras: Meiji from 1868 to 1912, Taisho, Showa from 1926 to 1989, including the war years, and Heisei during the current emperor's reign. Japan's Reiwa era will be an important one for the country. The third largest economy in the world, Japan faces significant challenges as its old rival China comes to dominate the Asia-Pacific region, and the country deals with a fast ageing and shrinking population. Since the boom years of the 1980s, Japan has struggled with a low-growth economy and a lack of economic self-confidence. The industries in which it was dominant, cars and electronics, have been attacked by new rivals like Korea and China. To counter this, the current government, led by Prime Minister Shinzo Abe, has tried to boost productivity, encouraging more participation in the workforce by women and addressing a deep-seated suspicion about immigration. For stock market investors, Japan has been a series of disappointments, which has left the Tokyo market one of the cheapest in the developed world. It's been particularly hard hit by Donald Trump's protectionism. The impact of the White House's trade policy is likely to be a key focus in the first quarter earnings season, which gathers pace this week, with around 150 of the S&P 500's constituent companies due to announce results for the first 3 months of the year. With earnings due to fall away after last year's sugar rush of tax cuts, analysts are starting to worry about the prospect of an earnings recession, meaning 2 consecutive quarters of lower profits. Forecasts are for a slide of more than 4% in the quarter under review, followed by a marginal decline in the 3 months to June too. This week's slate of company announcements includes Twitter. Shares were up 12% on Tuesday after better than expected revenues. Facebook and eBay in the tech space. Southwest Airlines, Boeing, Lockheed in aviation. Coca-Cola, which was up 2% after good results yesterday. Chipotle and Starbucks on the consumer front. And Halliburton, Exxon and Chevron representing the oil business. The performance of these and many other companies over the next few weeks will go a long way to determining whether or not investors have been right to reverse the sharp share price falls that marked the final 3 months of 2018. Yesterday marked a milestone in that recovery as the S&P 500 overtook the previous high reached last September. On the 20th of that month, the US benchmark hit a new all-time high of 29.31, and yesterday it closed at 29.34. The Nasdaq technology-focused benchmark also hit a new high, rising above last August's peak. That's dragged other markets around the world higher, with strong gains for shares in China, Japan, Europe and the UK this year. The FTSE 100 was boosted by gains for the oil sector, with BP and Shell between them accounting for about 14% of the value of the benchmark. As well as corporate results, the health of the US economy will be in focus at the end of the week, as first quarter GDP will be in the spotlight. An annualised growth rate of around 2% is expected, as the impact of a long federal government shutdown and cooling consumer spending is felt. And finally, just in case you thought Brexit had actually gone away over Easter, well, it's back. And fresh from another walking tour to clarify her thinking, the Prime Minister is under growing pressure to push through a deal or step aside. She now seems ready to risk a new push to unlock the deadlock by bringing forward key exit legislation, even as talks continue to find common ground with the opposition Labour Party. A vote could happen as early as next week. The urgency to kick off the legislative process is that this may be the last chance to push through Brexit while still avoiding the need to hold European Parliament elections on the 23rd of May. It's risky because if the bill is rejected, as currently seems likely, it can't be reintroduced in this session of Parliament. Mrs May's options are narrowing, and the likelihood of her surviving as Prime Minister beyond the summer looks slim.